Hey guys, welcome back to another video. If you guys are brand new, my name is Akil Stokes. I'm a Forex trader, trading coach, and one of the co-founders of Tier1Trading.com. And this is a weekly video that I do walking you around the markets, showing you what's on my radar for the week to come. Do me a favor, if you are brand new, make sure you subscribe to this video. Also, make sure you hit that little notification bell. Typically, these come out on Fridays, but sometimes my schedule gets busy, so maybe a Saturday or a Sunday. But if you have that bell hit, you won't miss it. Now, today I got a long video for you, so I'm gonna shut up quickly and not bore you to death. But if you haven't done so already, make sure you sign up for our free 4-day online trading workshop called Bridging the Gap. It is Monday, November 18th to Monday, Monday, November 18th to Thursday, November 21st, and it's going to be jam-packed with information. You're going to get taught by multiple coaches. We're going to teach you a strategy that you can use right away, of course, after back testing. We're going to talk about market mindset. We're going to do a lot of live analysis, so following up on many of the pairs that we look at today. And we're even going to bring in one of my buddies from the stock market to show you how the same concepts that we teach in Forex can be used in other markets in the exact same way. So it's going to be a heck of an event. Don't miss it. Sign up using the link below. All right, so here's a look at what's on the radar for today in the video. Skip ahead if you want to look at a certain pair, and I hope you guys enjoy. All right, so let's get started on the euro dollar. And the euro dollar isn't actually a pair that's on my radar for this week, but I did put out a message on social media this morning saying, hey guys, if you have any pairs you want me to take a look at, let me know. And the majority of the answers came back the euro dollar, which isn't too surprising as it's one of the most popular pairs in the market. But in last week's video, we took a look at an advanced pattern formation. It was a bat pattern, just to give you some perspective that looks like this. X to A to B, B to C, then a C to D about right here. You can see we traveled a little bit lower than the D completion, which is normal, but we haven't violated our X leg. So far, I hope we don't jinx it, so far we're getting some pretty decent movement on this bat pattern. Now, the question is what's next? And again, for me, there's not too much on the radar, but there is a smaller counter trend trading opportunity that may be available. And we're gonna start off by going up to the daily. So if we take a look at the daily time frame, right, you'll see that this bat pattern, right, actually also formed a double top. Now, if you guys are unfamiliar with double tops, we are going to talk about that in next week's webinar, next week's workshop, I should say. But a double top is a simple pattern formation where, well, the market does exactly what it sounds like it does. It puts in an initial top, right, an initial structure high. We retrace off of that structure high, and then we retest that structure high. And instead of continuing like we would in a strong trending market, we actually hold this previous level of resistance and we get rejected for the second time, giving us a conservative signal that the market is likely to reverse. Now, if you're someone that is looking for an even more conservative way to trade a double top, or perhaps you missed it and you're looking for the next move, there's a technique that we teach called the 26-18, and it's really no different than a normal pullback trade. So what you're looking for is for the market to pull back into the valley of this double top, anywhere in the range of this valley to the previous structure high, and then you're looking for the move or looking for the market to continue down. Now, in this specific scenario with the euro dollar, I'm in a neutral standing territory as far as overall trend, right? I see nothing on the chart that says we're more likely to go bullish than bearish. I see nothing on the chart that says we're likely to go bearish than bullish. We're in really a bullish rotation right now, which essentially means the market wasn't a bear trend. That bear trend has been violated per our rules on how to identify a trend. And now we're kind of waiting for the market to show its hand. So that's one of the reasons I'm not interested. But if you are, here's what I would look for. If we look at the level, the valley here, this is kind of the V part of the double top. That's what I call the valley because I'm not creative with my terms and couldn't think of anything else. If you take a look at this level, we have a few interesting things happening here. First, right, as my trading mentor always taught me, look left, structure leaves clues. You can see at this previous level, if we keep going back, we have previous structure support, right? After we violate that level of support, we come back up and we have resistance, 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 right? After we violate that level of resistance, we come back down and we have support. And after we violate that level again, this is an area where I would expect to see some type of previous structure or some type of resistance to the upward move. Now, does it mean it's going to happen? No. And I've gotten to a few arguments over the last couple weeks about technical analysis and traders under the assumption that technical analysis means that something is going to happen. And that's completely false. Or conversations that say, back testing is pointless, technical analysis is pointless because the past can't predict the future. And, again, that's completely false. Yes, the past can't predict the future for sure. Just because something happened in the past doesn't mean it's going to happen in the future. But if you're a true market analyst, if you're a true technician, what you're looking for is patterns and trends in the market. And you're not looking for the past to tell you what is going to happen. Rather, you're looking for the past to tell you what is most likely going to happen. And it's the same kind of concept as like, if you go into your car, right, and you turn your key, right, what do you expect to happen? You expect the car to start up, right? Why? Because every time, well, most of the time, you've turned your key in the past, the car has started up. Now, just because it started up yesterday, right, doesn't mean it's going to start up today? No, right? There's going to be some point in time where your spark plugs are messed up or your starter is worn out, and it doesn't happen, right? But you can make a good assumption that this is likely to happen because it has happened. If I've done this in the past or if I've seen this in the past, then it's more likely to happen than not. And that's what we're doing as technicians. We're playing probabilities, and we're combining that with proper risk management to put ourselves in probable trading situations. So, sorry about that. Didn't mean to get on that rant, but I get fired up about people that don't really understand technical analysis and make these assumptions of thinking we're like these voodoo witch doctors that say this has to happen. It doesn't. We're no different than the casino, right? Why does the casino make money? Because the casino has the edge, meaning that most of the games, or all of the games, I should say, aside from maybe poker, and that's a little bit different, all of the games, the casino has the edge, meaning the casino has the probability of winning, right? The casino doesn't win on every single player, but the more people it floods into the casino, the more chances it has of winning, and it consistently just produces profit, right? Trade like the casino, right? We're the same way. Another thing that stands out for you guys that have maybe been through the foundation course and kind of are getting nerdy about candlestick patterns is look what you see happening here, right? As we've tested this level, right, 2 long wicks to the downside, right, showing that selling pressure was rejected. As soon as we get down to that level again, after this high momentum bearish candle, 2 longer wicks to the upside, showing that the buying pressure was rejected. So if price action were to come to this level, this would also hit your targets for the bat pattern, which would be great. Then I would take a look in this level for a potential selling opportunity. Now, this would be a very short-lived counter trend trading opportunity, meaning I'm not expecting the market to come down and retest the lows and certainly not come down to retest these lows, but potentially a move from, say, what is this, about 110.90s back down to about 110.50s. Is a pretty realistic move, and that's 40 pips. And I know some of you guys on the internet, you guys are scoffing and laughing at 40 pips, but I think if you ask any serious trader, you catch a 40 pip move, especially in these low volatility times, that's a pretty decent move. So keep an eye on this level on euro dollar next week for a potential selling opportunity as we come into this previous level of structure, really starting at about 110.63s and working its way up right below the 111 even handle. Next, we're going to head over to the pound dollar, the cable. This is another pair that's been in consolidation on the higher time frame. We've been watching this for a while, and typically in this situation, we would look for what you see right here, a break and close below structure, as that would give us a pretty decent sign of what direction the market is likely to go in next and really set up how we want to handle our trade. But if you can see my little boxes here, these are notes from 2 weeks ago, right? There's no live trading room this week because I was getting my solar panels installed. Want to do that before next week's big event, just in case something happens. But we actually identified 2 important levels below this level, kind of crossing out this violation. So we technically do have a lower low, lower close here as far as this red candle. If we identify a lower low, lower close, then we can predict that the market is more likely to continue lower than higher. However, we haven't really cleared the level that we're really paying attention to. So I'm still in a neutral standpoint when it comes to this pair as well. And that's not a bad thing, right? Consolidation is not a negative, because consolidation will breed pattern formations, right? And that's one of the ways that we take advantage of choppy markets. And you can see here that we have another advanced pattern formation forming. If I take my Fibonacci extension tool, from my impulse leg here, my swing high to my swing low, right? This directional move, you're gonna see that we come up to a 618. A 618 puts me on alert for what's called a Gartley pattern, right? This is gonna be called our X to A right here. This would be our A to B. And I know that I'm looking for a completion right underneath that, or right above, I should say, that 786. And that's gonna be where my 127 Fibonacci extension rests. So looking at an X to A to B, B to C, and then a CD completion right in this point around 129.35 for a potential bearish Gartley pattern here on the pound dollar. And what's kind of decent about this as well is, I talked about the violation not meaning much, but we have seen a trend here as far as our highs go. If we look at our most recent highs, right? Here's our highest watermark, right? The market traveled up to this level. This is the highest point it's been to recently. And then we retraced. I guess down here, we retraced. We came back up, and what do you notice about this high compared to the previous high? Is it higher or lower? These are sort of the small things that we look at in the market, right? It's lower. And then we come down here, we put in another lower low, right? You can see the trend happening here. And then we come back up, and if we completed this level, we don't know, but we know that the pattern isn't violated until our X leg is. So if we complete anywhere in this zone between the 127 and the high of our X leg, we're going to be continuing that pattern of creating lower lows and lower highs. And that's a positive sign for bearish movements. That's something else you want to keep on your radar when it comes to the pound dollar. Next is going to be the euro yen. And again, we'll start on the daily just to gain some perspective. This was a pair that I was wrong on, right? This was a pair that I was wrong on. If you guys are new, right, this isn't one of those trading channels. I'm not one of those trading coaches where it's like I'm right every single time and I'm only going to highlight the winners and I'm going to ignore the losers. Believe it or not, there are people that do that. This was a pair where a few weeks ago, and even up to last week, we were looking for a bullish breakout, right? We had consolidation here. You can go back and watch a previous video. Consolidation here, and we were looking for a potential breakout. Now, this was an iffy situation. I remember using that word because what was important is that we didn't violate previous structure highs. However, I still thought that we would break out to the upside, and I was looking for an opportunity to buy, a very low-risk opportunity, to buy at the lows, right? Giving me a very small risk like this. And then trade first target to retest of our structure highs here, and then trade higher, right? A very low-risk situation. Now, here's the key point. And this is what separates kind of the professional traders from the struggling traders, right? I was wrong on my analysis, but I didn't lose any money. Now, you're probably asking yourself, well, how can that be? How can you be wrong and not lose any money? Well, because I didn't trade it. I didn't trade it. And there's something I tell our traders all the time, right? We want to be predictive in our analysis and reactive in our execution. This goes back to the same conversation I had with the people that were poo-pooing technical analysis, where they assume that because I predict a move higher, the market has to go higher. No, I predicted a move higher, and then I went through my trading plan. I said, okay, well, if this happens, then I will enter, right? And then entries go here, or targets go here, stops go there, the rest of it. We never got that signal. I was looking for a double bottom at the very lows here. We never got it, so I never entered the trade. So yes, it's wrong in my analysis, and guess what? I'm wrong a lot in my analysis. You ask any trader out there, they're wrong a lot in their analysis, but there's a difference between being wrong in your analysis and losing money. And sometimes you are, don't get me wrong. I'm about a 50% trader, so I lose almost as much as I win, about 55%, give myself a little bit more credit, but I lose basically just as much as I win. The difference is I don't lose on dumb trades, so trading mistakes where I assume something's gonna happen and I enter right away and I lose money because I didn't wait for confirmation, and I control my risk, right? So routinely, when I lose less than what I make when I win. And that's just not the sexiest way of trading. It's not gonna win any short-term trading competitions. It's not gonna get me all the likes on Instagram or whatnot, but it's brought me consistent profit for the last, 10 years now? And I will gladly take that, right? Slow and steady wins the race. What you can look for now, however, is a retest of these lows for a potential short opportunity. If we go down to the 4-hour time frame, you'll see exactly what I mean, right? Again, we look at this level right here, holding, right? This was the level I was looking at for a 26.18 opportunity, and because we went all the way up here, right, with the higher high, higher close, never gave us a chance to enter. But we broke past this level, these lows, and now we're coming back into a previous level of structure support, which we would predict should act as resistance. Yep. So just like the euro dollar situation, look for shorting opportunities in here. Again, I wouldn't be too, now I'm just conservative by nature. For you guys that have followed me for a while, I started off as just a counter trend trader. So I kind of like being in and out and not really shooting for that many home run trades and kind of getting my money and being safe. But I wouldn't shoot for anything extending down here. The reason being, we just came to previous structure support and we held, right? If we would have broken and closed below this level, then I think it would have opened up the window for bigger target taking. But the most aggressive I would be with targets is a retest of this structure. If anything, at least take a partial position off at that level. Don't leave kind of the full position on board. But that's a pretty decent opportunity here on the euro yen to pay attention to. Ideally, I think we should see some type of hold. Really at 120s where we're at, right? We're above 120s. 120 was this 120.15s we're at right now. But as long as we stay below the 120.63 level, this would still be an opportunity on the radar. Let's go to Aussie dollar. Real quick, just take a quick break real quick. I want to show you guys a little note I did, kind of a pattern interrupt. I know we give a lot of information in a short period of time. Your brain gets overwhelmed. But I share these infographics all the time. And here's one that stood out to me the other day. See if I can bring it up here on my Facebook amongst all the other junk. Shameless promotion, Bridging the Gap, a global online trading workshop, November 18th to 21st, free. Let's go to, where's it at? I don't want to boost anything. Nope. Come on, computer, being slow. Oh, there's the solar if you guys didn't see it. Here's one right here, right? The chronic pearls of overthinking, and I think this is this works in many levels. I shared this post originally, kind of talking about people that are scared to actually commit to trading. They're looking for the perfect system and whatnot, and they end up never actually trading because they're hunting for perfection. For you guys that have listened to me on the Trading Coach podcast, I've shared a story of my friend before who was a system developer. He developed some very, very, very good trading systems, but he never actually traded them because each time he got a certain win percentage, he wanted more. So he brought his system up to 60%, and he's like, no, I think I can get to 65. He got to 65, I think I can get to 70. And he ended up getting up to like 70 something, and he wanted more. He wanted to get to 80 to 90 to 100, and he never actually traded it because he kept overthinking and wanting more. And I think this is a good concept because we just talked about really about being wrong, right? And how you can be wrong but not lose money, but you can also do everything right. You can have the perfect setup in the market, and guess what? It doesn't work out. That is trading for you. It sucks, but it's trading. But what happens to a lot of struggling traders, and you can leave a comment below if this has ever happened to you. I think you guys are going to be amazed at how many people actually comment, is we let our ego take a hit. We see everything right. We do everything we're supposed to do, right? It's a grade A trade, it's a grade A good trade. And then the market doesn't give us our reward, doesn't give us our profit. And then we start overthinking. What did I do wrong? Did I make a mistake? I posted this on Instagram. What are people going to think of me? Man, I know I'm not good at this technical analysis. What am I doing wrong? Is it my system? Is it and you get all this stuff in your head, and it hurts your confidence. In reality, you did nothing wrong. The market just doesn't win all the time, right? But it can start to wear on you and wear on you and wear on you, especially when you're alone. And this happened to me a lot. Whenever I would go on a losing streak, we call it a drawdown, when you lose, multiple trades in a row, I would start thinking all of this thing, like, I'm not good at technical analysis. Did I read this wrong? Blah, 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 blah. And it would just push me into a deeper hole. And I would get really, really scared to enter the next trade. I would see another perfect trade set up and I'd be like, okay, that last one. And in the past, I would miss trades and it would end up being a winner. And I'd be, dag nabbit, be all mad and stuff like that. But you got to focus on the process, and it's hard, but if you can, surround yourself with like-minded individuals. Misery loves company, so if you ever find yourself in a drawdown, talk to some other traders. If you guys are on the platform, I dare you to go into the chat and say, hey guys, I'm on a losing streak, anyone else? And I bet you'll get about four or five answers on there, either saying, hey, yo, me too, I'm kind of in a funk right now, or yeah, I just got out of one, here's what I did to help. And sometimes you just need that boost, that light at the end of the tunnel to kind of give you confidence. But I bring this up because I don't want you overthinking. If you lose a trade, it's not a bad thing. And the paradigm shift that you need to make is process over outcome. The result doesn't really matter. The question is, am I doing everything right? Because just like the casino, you're not going to win versus every player in there. But if you consistently take the right actions, you'll consistently get the result that you want. So, all right, let's go to the Aussie dollar next. Aussie dollar, we have a cipher pattern here. Well, technically, we don't have a cipher pattern. We didn't hit the 786. I'll show you what I mean. Our cipher looks like this on the Aussie dollar. X to A to B, B to C, and then a CD completion right down at the 786. Now, our 786 completes at about 67.67. You can see price action came to about 67.70. Now, this is what we talk about by front running, right? When I say the word front running, it's not like the illegal type of front running that you have probably read a couple years ago in the books. It means placing your orders a little bit above where you expect the completion to be. The unique thing about the Forex market is that there's no central bank, right? That's one of the reasons we can't really trade off volume or true volume, because there's no central bank. So you're going to get different quotes. Typically the quotes are the same, but depending on where you're at and your broker, you may get different quotes. So when we're looking at areas of support resistance, we're looking at areas, even for you guys that use pivot points or Fibonacci's, we're looking at areas. We're not looking at a specific price. There's not a specific price that we should pinpoint. There is an area in which we should look for that reversal. And what front running does is, front running says, hey, this is the Fibonacci point, the rules-based Fibonacci level that I want to enter in. But what I'm actually going to do is I'm going to get my orders a little bit above it just in case we come close. Because I don't know about you, but it sucks when you come really, really close and you don't get filled. And this is a good example of when this would have paid off. Now, again, are you increasing your risk a little bit? Yes. Are you reducing your reward a little bit? Yes, but you're giving yourself the opportunity to be in a good trade. And for me, I'll take reducing it by, reducing my risk, reducing my reward by 5 pips and increasing my risk by 10 pips here on the higher time frame. I'll take doing that to give me an opportunity to get in more high probability trades. So this could come back. We're not necessarily going to see a double bottom here because we had a higher high, higher close, but two things you can look for. I'll give you one bullish opportunity and one bearish opportunity. This is going to be probably more lower time frame intraday stuff. So hopefully we'll get a chance to look at this during the bridging the gap workshop. But where I think the market is likely to go next is here, right? This little period of consolidation between 68.20s and 68.40s. And I talk all the time about analysis being general. There's no type of trend trader analysis or counter trend trader analysis. It's just analysis. And you can just use it different ways, right? So this is my projection of where I think the market is going to go, which means two things. If you are looking to sell, then you are waiting for the market to come to this level, and this is where you're looking to sell. If you are looking to buy, well, if you have an opportunity on a lower time frame, say we get a little pullback action right here, then this is a target area where you're looking to sell, right? So you see buyers that bought around here, they're selling to take profit. Sellers that are interested in selling right here, they're selling to enter a trade. It all works out for both parties. It's not necessarily a winner and a loser on every transaction like, I think people assume. People assume if someone wins, someone loses. No, you can be a buyer, I can be a seller. We can both win at the same area despite having different orders on there. So this is a decent opportunity to keep your eye out for on the Aussie dollar. Of course, if we do retrace, because we haven't hit, we're nowhere near targets on this. Target's going to be up at this area, actually, right into here, 3D2. If we do retrace, it still gives you a secondary opportunity to get involved in the cipher as well, so you can take a look at that. Aussie Canada, what are we doing Aussie Canada? Aussie Canada had a nice run on the daily. If you guys remember this from, this had to be 2 weeks ago. X to A to B, B to C, C to D. Give us a little, come on. Gave us a little trouble at first, and then we fell off a cliff here. Similar situation as Aussie dollar. You look at this little box down here, right? This is where I expect price to go. If we're going to continue lower, I expect price to go to this level. So this is a level you should have on your radar, whether it's to look for a buying opportunity at this level or a selling opportunity in advance of this level. Now, what we have to do in order to get a selling opportunity, in my opinion, is break these lows, right? You can see we went down to the 4 hour, right? And we had a nice little pregnant pause right here, and we've held that level. So in order to project that price would continue down there, what I would want to see here, what I would need to see here on the lower time frame is a violation of these levels, and then I can make the prediction that we're likely to continue here. Now, for someone looking for a buying opportunity, you can see that we've double bottomed down here. We go down to the hourly, that should be a little clearer. So, actually not a valid double bottom on the hourly, I take that back, but we still have kind of a new trend, new smaller trend being created. You can look for the same thing we talked about on the euro dollar, just inverse, right? A 26.18 opportunity, right? You pull back in the structure and then an opportunity to trade it up to this previous level of consolidation right before this high momentum engulfing candle. So you can see there's not, at least the way we teach here at Tier 1 Trading, there's not a lot of fancy concepts. There's a kind of a core. I think there's 3 ways to trade. For you guys that took the Foundation 2 course, if you've gotten there already, we break that down. There's only 3 ways to trade. Now, within those 3 ways, there's different kind of techniques and tactics that you can use, but the general principles are simple. And I think once you master that, you have a completely different look on the market. So let's continue through here. I think we have a few left. Pound Canada. Oh, this is the last one, Pound Canada. Pound Canada is giving us an ascending triangle, right? And this is another opportunity where you can see previously we had a double top, right? So you can look at this, you could be saying short, 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 short. Now, again, I wasn't interested in the short at this level mainly because it's not at a key level of structure. This is a good example of it's not the what, but the where that matters. But this is how the market changes. You could look at this as a double top, right? RSI overbought, bullish or bearish divergence on the retest and say this is a good shorting opportunity. And let's say you get short. And then as the market continues, right? You're all excited. It's going in your favor, going in your favor, going in your favor, right? Pauses a little bit, but still in your favor. You're in the profit. You're doing the money dance. Oh, look at that. Great candle, even though it's green. Uh-oh, what's this? We have created higher lows. And what has happened here is that this pattern has transformed, which once was a double top, which was a bearish pattern for a selling opportunity, now has become an ascending triangle, which is a sign for a bullish breakout. So what I would look forward here to, there we go, that's why I trade and I don't speak, is a bearish breakout. Right, a bearish breakout to the upside. If we're likely to break out higher, we're likely to go to about this 173.13 level, right? Anywhere between 173.13s and really 177.37. This is a massive pair. That's why that range is going to be big. If you want to break down that level, we can do something like bring a Fibonacci extension on from a most recent swing low to swing high. See if that gives us any confirmation. Yeah, you can see, look at that. 173.16, that's right about the lows that we projected before. So I think that's a good conservative place to look for a breakout to go to. We could even do this. I didn't do this before, but let's see. 786, 786, 786. Ooh, close, so close, so close. You can see a nice level to look for a bullish breakout. And of course, you guys know there's 3 ways to trade the breakout. There's setting up your position prior to the breakout. There's catching the ride during the breakout, or there's waiting for the breakout and looking for a retest. But this is a decent opportunity and a good example of how analysis changes, right? And you weren't wrong. If you were someone that looked at this double top and said, hey, this is a shorting opportunity, and now you're seeing this, you're not wrong. The market has just adjusted, right? And as a trader, what's important is that we adjust as well. That's why we go through that IPDE process every single time. We adjust, we adjust, we adjust. And many times it means changing our opinions, and there's nothing wrong with that, right? Trading is not an ego game, right? We can't be in love with a certain setup. We can't be so in love with this double top that it only can double top and go short, and there's no way we can change and do something else. No, we got to be like mercenaries, right? I don't care if the market goes up or down, right? I want to make money if I think it's going to go up. I want to make money if I think it's going to go down. So you got to be quick in changing our opinions and just honestly reading the market instead of falling in love with our analysis. And I keep bringing this up because many of you guys post on social media falling in love with, kind of being stuck into stuck into our analysis because we're afraid of how we're going to look, right? I don't know if you guys saw the post. I'll go back to one more Facebook post. This is a good example of being stubborn. This is a lot of traders could not believe this, but I swear it's true. I swear it's true. It was a post I got on TradingView, right? And I get this all the time, but this was a very interesting one, right? And again, I got 18 million things running at the same time, so it's a little bit slow, but let's see where it's at. Keep going, baby. Keep going. Keep going. Where's it at? Man, I put out a lot of stuff here. Marathon. Nope, it's before that. I thought I put it up here. It was the thing about the person who was talking. Here it goes, right here. It just looked like a post. So this post right here. I was talking to a trader on TradingView. He asked me a question. He said, He said, my total balance is 13,450, and I am now losing 5,000. Shall I close and take a 5,000 loss, or should I wait? And it might improve. What do you advise me to do? And this trader was, I believe, in 2 positions on the dollar yen, and obviously the positions aren't going in his favor because he's down money. He obviously doesn't know what. Obviously, it's not a good trade, right? If it's a good trade, entry stops and targets beforehand. But the point is, he probably did some type of analysis, hopefully. And that analysis told him one thing. And now the market is obviously telling him something else. And it's time for him to bail. So I gave my coaching response, right? I said, well, if you have to ask what to do in a trade, it means that the trade wasn't part of your trading plan. If that's the case, I'd consider it a bad trade, which means I should close all positions. Or I would close all positions immediately. And that's kind of my mindset in the market. If you ever find yourself in a bad trade, right? Whether it's, you take an emotional trade at the time and you're like, man, I shouldn't have done that, close immediately. Or if you find yourself in a trade and you just made a technical mistake, I've done that before, where I thought we've hit a certain level and we didn't. I'm like, oh man, I messed up. Close immediately, right? Cut your losses. Don't make it worse than it already is. And the same thing here. If you do something with analysis and your analysis says one thing and now it's transforming into another thing, right? Don't let it just cause you to go broke, right? Get out of it once the market tells you something else. And this trader's response were, thank you for the advice. I will keep my positions. There is something called hope. I don't think you know it. I mean, I'm never one to tell someone that their trading plan is wrong, but I would say this, right? If you're on that great trading drug called hopium, it usually ends bad, right? It usually ends bad. But this is an example of a trader being so emotionally involved in his trade. And it could be ego, it could just be fear of losing money. It doesn't matter. They're so emotionally involved in this trade that they are blinded to seeing that the market has clearly given them a different answer. And instead of taking a $5,000 loss, which they would right now, they're probably going to blow their account. And you know what? I hope it doesn't happen. Maybe they win. But that would be even worse, because if they win, now they win some money. Now they start probably trading bigger because they're all hyped up on their ego train, saying that I'm the great trader in the world. And eventually that hopium will fail and they'll lose even more money and more importantly, even more time. So you have to be adjustable in the market. And that's one of the reasons that we teach trading with a process, right? Identify, predict, decide, execute. Process every time. That way you can do your checks and balances to make sure that you're actually reading the story that the market is giving you instead of just making it up. So long video today, but I hope you guys enjoyed. If you did, again, do me a favor, leave me a comment below saying, hey, Akil, I like this video, or any questions that you may have about it. Also, make sure you subscribe to this channel if you're new, and make sure you share this on social media. That is a big, massive help for me. Last but not least, you've probably done this already because you guys are traders that are looking to get better, but make sure you register for the Bridging the Gap workshop starting November 18th. It's a 4-day free online trading workshop. We're going to teach you some cool stuff. We're going to teach you a strategy that you can use right away after you backtest it, of course. We're going to teach you some of the technicals and the basics of trading. We're going to really give you a lot of practical analysis, so a lot of live trading, a lot of live trading review. You're going to see what you saw here. We'll probably follow up on a few of these opportunities. It's just going to be an awesome time. We're going to do a lot with stocks as well. I got my buddy Mike coming in, who's going to teach a little bit about trading psychology and really how to use the same concepts that we teach here in Forex in different markets, which is pretty cool, because we always say technical analysis is the same. Any time frame, any pair, any market. There may be slight differences, but the foundational elements are true. So I'll see you guys next week. Until then, plan your trade your plan. Thank you for taking 30 plus minutes out of your time to listen to me talk, and you guys have a great weekend.